Hello everyone, welcome to the channel. Back again after a social media break. Today we're going to talk about annuities. Now what are annuities? Annuities are savings accounts by a life insurance company. It's really that simple. It's really a savings account by a life insurance company. Annuities are generally categorized by two ways. The first way is how interest is credited. Is credited. And that could either be fixed or variable. Fixed just means it's a fixed index, fixed interest based on what's guaranteed. Similar to a whole life policy where you have a fixed amount coming in terms of interest from the general account. You can have also a fixed index where you get a fixed rate that's higher than normal because it's tied to an index, right? Variable mean it's actually invested in the stock market. So whenever you see the word variable to describe a life insurance product, that's what it means. It's actually invested in the stock market, which means it has a much higher potential for high gains, but also you could actually lose your principal or lose money. So you can, yes, you can gain more, but you also could lose. So understand that. The next is when it annuitizes. In other words, when the payout happens, when do you get paid back from it? And so that's the second way, when it is, I'll put paid out to be simple. And that's either a deferred annuity or an immediate annuity. So deferred means it's later down the road. Whether you want, you're going to actually lock up your money, either similar to how a CD works. You're going to lock up your money for 3 years, 4 years, 5 years, whatever the terms may be, and you cannot touch it. It's for those who don't really need that money. You have money sitting around in the bank, and you're not gaining much interest on it. You want to put it somewhere else to make a lot more than the 0.5% in the bank. You want to make 5% or better. You put it in an annuity, and you don't need the money. Now, if you do touch it before the contract is over, then you get penalties. So deferred annuity is that. It means it annuitizes down the road. You could choose to get paid out from it, or you can choose to actually renew the contract and lock it up for another 3, 4, 5 years. And then you have the immediate annuity, sometimes referred to as an income annuity. Now that means you're going to get payment. It annuitizes immediately, which is in 30 days. So usually people put in a lump sum payment, one single lump sum payment. You do have the option to put multiple payments, but generally speaking, people put one lump sum payment into an annuity, whether it's a deferred one or an immediate one, and then they start getting paid out if it's an immediate within 30 days of making that contribution. All right, so which brings me to the next thing. The next thing is the stages. So the stages of an annuity, you have the contribution, you have the accumulation, which is similar to most financial products. These are the stages: accumulation. Okay, then you have the distribution. This is when it annuitizes. And then you have transfer. So I'll explain each. So contribution is when you put your payment. You have to fund it. Just like with life insurance, people use cash value life insurance. It's not a charity thing. You have to fund it to be able to take advantage of the leverage. With annuity, same thing. You have to put money into it to fund it. So contribution. Then it accumulates. This is where it grows. Okay? So it grows here. It's growing interest, and it's becoming more than what you put in. All right, so it accumulates. Distribution is where it annuitizes, which means that's when it starts paying you out. And the great thing with an annuity is that it can guarantee you lifetime income. So if you live longer, you're going to get a lot more out of it than if you die earlier, right? So it annuitizes. And then transfer, whatever is left over, if you didn't use up that money that's there, whatever is left over, transfer to your beneficiary. Now, one distinction I want to make with an annuity, different from a life insurance policy, is an annuity is taxable when it's transferred or when you take money out. You're going to pay taxes. So it's tax deferred. It grows tax free. It accumulates tax free. So it's tax deferred. But once you start receiving money from it, you're going to pay taxes on any gains. You don't pay taxes on the money you put in, but you're going to pay taxes on any gain. When you transfer your beneficiary, unlike with life insurance, we're always transfer tax-free to the beneficiary. Here, the beneficiary will pay tax on the money they receive there. So, who is this for? Who is the ideal client or prospect for an annuity? Now, unlike life insurance, you don't need to qualify health-wise and all that. So with an annuity, you don't have to do that, right? So who is this good for? It's usually good for people 55 years or older. So suitability is a key factor with annuity, right? Suitability is a big deal. With life insurance, health comes into play and all that. None of that comes into play here, but suitability is the main thing here. They want to make sure it's suitable. So if you're selling an annuity to, let's say, a 25-year-old person, they're going to question that. Why would that person want to lock up their money? They're young. They might need the money, number one. Number two, they probably could do better. They can probably even get more aggressive in terms of interest and earning more than locking it up into an annuity, because there's other financial vehicle that could do more for them because they have more time. They could be more aggressive. So even if they lose, they can recoup. Whereas when people get closer to retirement, they're less likely to be able to take on losses because they want to secure retirement income. So it's good for people that's close, like 55 years or older. It's good for people who have their money sitting in a CD, like in the bank, not doing anything for them, and they want to put it somewhere that's also safe, because a lot of times people put their money in the bank because they think it's safer. So I don't want to lose anything. I'm comfortable with putting in the bank. But how can you still earn more and still be safe? You could do an annuity instead, right? Who else it's for? Those people mainly, but people roll over as well. They might have an old job that they left and they have a 401k. They can roll over that qualifies fund into an annuity without paying taxes up front. Or someone that had an IRA. So IRAs and 401ks are great things to move over, roll over as a qualified fund into an annuity as well. Well, I hope the information was valuable to you guys. If you have any questions, please let me know. I do want to make sure that this is reaching out to more people. So I'll ask that you like, comment, and share. Share with someone so someone else could get the information. Okay? So until next time, I'll talk to you soon.